introduction of codes for responsible investing in South Africa has led a number of trustees and other investors to engage asset managers more in what they're doing to encourage consideration of environmental, social and governance factors in the investment process. Ann Leepile, head of manager research at Investment Solutions, joins us in studio to give us some insight into responsible investing. Now let's jump right in there in terms of how you see responsible investing, if someone was to ask you to describe it.
Yeah. I think that the focus on responsible investing is something that is long overdue. I think that the investment into companies that don't have sustainable business practices, especially in the South Africa context, was wrong to begin with. So we are seeing that companies are paying greater focus on the ESG factors. Obviously ESG factors do differ depending on which country you're discussing, and the different factors are more or less relevant in different countries. But in South Africa specifically, we're actually seeing a lot of clients, trustees asking us to say, are our asset managers doing the right thing?
Warren, I think you're going to have to jump in here as well.
Yes, yeah, and I just wanted to, obviously there's the socially responsible investing, which many asset managers have created specific funds for. So can you just give us more idea, because I sort of sense talking to fund managers that it's always been about the financial objectives and the financial returns, but certainly in mining, where we see globally the likes of resource nationalism and issues coming to the fore around how these businesses operate. What's the sort of take by fund managers? Are they seriously considering the idea around sustainable investing and looking at the factors, the way in which mining companies, for instance, operate in certain countries? Is that part of their risk management process yet, or is it still kind of an afterthought at this point?
Guys, I think the previously what we used to have was funds that are being created. So as you said, the socially responsible funds were being created, but those were very much tick box processes. So have we done that right? Do we have an SRI fund as part of our fund offering? What we are now asking managers to do, and I think maybe CRESA in particular, what CRESA is asking managers to do is looking at every single aspect of your investing process. Are you considering the sustainability element of it? Are you making sure that these businesses are sustainable going into the long run? So even if you're not just discussing mining companies, we are saying every single element of investing, engage with management to ensure that the guys are doing the right thing. Engage with management to ensure sustainable employment practices. The resources companies, in fact, I think have an advantage because they've been in this space for so long. They've got the rehabilitation funds that they've had to create and things like that. Whereas I think some of the more industrial type companies haven't. So they are now also being forced to produce sustainability reports, and it's an interesting space at the moment.
Yes, it's an interesting space, but in light of all the volatility and uncertainty and the low yield environment, is it really going to get enough attention right now when people are really just trying to make ends meet and work solutions that are going to keep investors with them?
In fact, I think now more than ever is the time to be focusing on these types of things, because to not focus on them, you are actually investing in companies that may or may not be around in a few years' time, because you've missed particular risks inherent in the business practices that could make or break a particular company.
Just in terms of that, obviously in a highly regulated country like South Africa, where we've got pretty effective structures to police labour laws and environmental laws and those sorts of things, do you think the ESG is more a risk for investment managers that are investing in companies on the continent, for instance, where the lack of institutional framework and policing means that companies can get away with things that they would never even think about getting away with in developed markets?
I actually think that's correct. I think that obviously Regulation 28 has only further added to the intense regulation for pension funds, that there is now a clause in Regulation 28 that is requiring that the investors of the pension funds actually focus on ESG factors. And I think that it is more relevant to make sure you are doing it outside the regulatory framework on the continent, because there isn't that much of a drive to focus on those types of factors. So you're right, I think that it does become a bit more difficult, but in fact I think that the need to focus on those sustainability factors is even more important, because you are going to find yourself with some unaccounted for risks simply by missing those ESG factors.
Beyond the theme that we're discussing right now on the responsibility issues, what are managers out there doing, the offshore versus local? What visibility do they have in light of all the volatility and uncertainty that I mentioned earlier?
The market is just giving them all proper whiplash at the moment. We are seeing some very interesting stats at the moment that, managers, all active managers, in the majority are struggling to even beat the benchmarks. Generally you have some managers relative to benchmark in first and second quartile and some at the bottom. We are now sitting at a point where if you look at our global manager rankings, I think as at the end of 2011, as at the end of Q1 2012, only 20% of global equity managers were actually beating the benchmark. That simply means that everybody is finding it challenging in this environment. And in fact, we're seeing it locally as well, that the local managers are really struggling to understand what is happening in this market, because what seems to be cheap only gets cheaper. And what seems to be expensive is only getting more expensive.
Absolutely. You're talking about retailers and construction. We've seen the story all over the place.
Absolutely. And I just wanted to ask, Ann, your work obviously encompasses looking at fund managers locally as well as offshore.
Yeah.
Offshore, I'm aware of many different strategies that we don't see in South Africa. Like, for instance, growth is fairly big offshore. I don't know of one momentum manager locally that pursues that strategy. Are those types of strategies prospering? Is any particular strategy standing out at this point, or is it just bloodshed across the marketplace?
I think the strategies that have done well are the strategies that are focusing on global franchises. So these are the companies that are looking at diversified income streams, your Unilevers, your Diageos, your Nestle's. The only concern there is those counters only continue to get expensive. They are no longer deemed quality because there's not much value left in those types of plays. But that is where everybody has moved to of late. We always say our job is not to analyze stocks as investment solutions, but once you've spoken to enough global managers on a 3-week trip like we do, you get to a point where by the time you come back, you are now fluent on like a Nestle, because that is all they are talking about.
And it gives new meaning to the terminology herd mentality, doesn't it?
Yeah.
Are there people out there trying to break the mold with creative solutions on the investment front? Is it possible?
Creative solutions means one needs to look outside the box. The traditional asset classes are not going to give you the returns we've previously seen. So one needs to be considering alternative assets. One needs to be possibly considering overweighting hard commodities. And that kind of stuff is a painful bet at the moment, So it does become very difficult, but managers need to consider alternative investment avenues. Some managers are really playing even offshore, which is surprising. We're also seeing the gold stocks being played as a big play against the gold counter or the gold commodity. But it's just a very difficult market for them to operate.
With creative solutions comes increased risk at the end of the day.
Yeah.
Absolutely. Just one other question, and in terms of, I'm just curious to know, in terms of the portfolio managers that are running flexible mandates, that have the ability to move into cash if they want to, what's the sort of weighting or the average that you're seeing now in those portfolio managers? Are a lot of them just saying, right, this is madness, this market at the moment, let's sit in cash for a while?
Yeah.
Or what's the sort of sense from your side as to how aggressive and how much risk they're taking at this point?
Warren, that's quite interesting, because we actually have spoken to some of our managers who don't have flexible mandates and said to them, do you want the ability to hold cash?
Right.
They've said no. Not our problem. We want you guys to make that call, because cash is a problem at the moment. While it is apparently a safe haven, it's a safe haven that's earning negative real rates. So the manager is already, by sheer virtue of them holding cash, starting on the back foot. Whereas at least if you manage to get the right stock picking skill in-house, you have the chance. Hasn't been very profitable, but you have the chance that you can at some point earn some sort of positive real rates, which cash is just not giving you at the moment. So managers are really saying thanks but no thanks to the flexible mandates at the moment.
Right.
Warren, you've interviewed a number of investors, and you do on an ongoing basis for Investors Monthly. Are you picking up many of the same themes that Ann is referring to?
Yes, although I haven't spoken to the foreign fund managers in a while. I will be speaking to them shortly, but certainly locally the guys are very defensive, and they're basically just, a lot of them are just sitting tight. most of the fund managers I speak to don't have a flexible mandate, which means they have to stay invested. So they can keep maybe 5% of their portfolio in cash. And all they're basically doing is they're just sitting on their positions. Where the extent possible, they will move into cash, but it hasn't been a dramatic shift with the flexible fund managers. So locally, I kind of get the sense that, with the all share has had a good run, and there are sectors of the market which have been very interesting. But generally, I think the real disaster has been overseas, and it's been very tough for fund managers to try and find a way out of the hole that they find themselves in.
Is there any sense of doom and gloom out there where people are starting to throw forward to comparisons between where potentially we are now and where Japan is 23 years down the line, so that we could see that hard times for all scenario that Clem Santa likes to put in picture?
I actually don't think so. I think, interestingly, the global managers, while cautious, are actually seeing a lot of opportunities in the market. So they are really trying to say that corporates are sitting with very cash flush balance sheets, so let's wait it out. There's opportunity with the amount of cash that the corporates are holding, so buy the right type of corporates and eventually the profitability will come through. I don't think that it's a doom and gloom scenario, which I was quite pleased about, because I think, considering their views October, November last year, managers are a lot more positive offshore.